For self-employed individuals in Canada, common tax mistakes include mixing personal and business finances, not reporting all income, claiming ineligible expenses, and failing to save enough for taxes throughout the year. Common tax mistakes and how to avoid them. 1. Mixing personal and business expenses. Using the same bank account or credit card for both personal and business use makes bookkeeping difficult and can raise red flags with the Canada Revenue Agency, CRA, during an audit. Solution: open a dedicated business bank account and credit card to keep finances separate and track expenses accurately. 2. Not reporting all income. All sources of income, including cash transactions, side gigs, or online sales, must be reported. The CRA has tools to track income, and unreported earnings can result in penalties and fines. Solution: use accounting software or a detailed spreadsheet to accurately track all earnings throughout the year. 3. Claiming ineligible or overstated expenses. Only expenses directly related to earning business income can be claimed. Common mistakes include claiming personal expenses, like wedding costs or non-business meals, or incorrectly calculating deductions, such as home office or vehicle expenses. Solution: familiarize yourself with CRA guidelines for eligible deductions. Keep detailed records and receipts to support all claims. For home office expenses, use the correct percentage of your home used exclusively for work. 4. Forgetting about GST/HST obligations. If your business earns over $30,000 in total, worldwide taxable revenue, over 4 consecutive calendar quarters, you are required to register for a GST/HST account and collect sales tax. Solution: monitor your revenue regularly and register for a GST/HST number as soon as you approach the threshold to avoid penalties. 5. Failing to plan for and save for taxes. Self-employed individuals do not have taxes automatically deducted from their income, which can lead to a surprise tax bill at year-end. If you owe more than $3,000 in a year, the CRA may also require you to pay in quarterly installments. Solution: treat taxes as a business expense and set aside a percentage of your revenue, e.g. 25–30%, in a separate savings account throughout the year. 6. Poor record keeping. Inadequate documentation, receipts, invoices, bank statements can lead to denied deductions if the CRA conducts an audit. Records should be kept for at least 6 years. Solution: keep all business-related receipts and documents organized using either physical storage or digital apps, doc software. 7. Filing taxes late. While self-employed individuals have until June 15th to file, any balance owing is due by April 30th. Late filing or late payment can result in significant penalties and interest charges. Solution: mark important deadlines on your calendar and file on time, even if you cannot pay the full amount immediately. Contact the CRA to set up a payment arrangement if necessary. Misclassifying workers. Incorrectly classifying an employee as an independent contractor can result in significant liabilities for unpaid payroll taxes, CPP and EI premiums. Solution: understand and apply the CRA's criteria for determining a worker's employment status. 9. Not seeking professional help. This is the biggest mistake a business can make. Tax laws can be complex and change frequently. Trying to manage complex tax situations alone can lead to missed deductions or errors. Solution: consult with a tax professional, such as EasyTaxCanada.com. We will provide expert guidance and ensure compliance. If you like our contents, please don't forget to like, share, subscribe, or contact us at EasyTaxCanada.com. Thanks for watching.